Risk and the short-term business loan model explained. Let's continue to discuss the aspect of this loan type compared to traditional bank loans. These loans are typically short-term, as you have probably concluded from the list above. This means a business owner who is foregoing a several-year-long project may not use this type of funding if they need to maximize profits. A business owner purchasing commercial real estate will not utilize this type of loan, either being that mortgages are more long-term and specifically leverage lower costs when considering resell of the property. Longer-term, traditional business loans are less expensive when looking at the rate alone. Which brings me to the next point. The reason longer-term loans are less expensive is because there is less risk. In other words, in the case of loans for real property, there is collateral involved, usually the building. Even traditional business loans have collateral, so if the owner defaults, the bank can repossess and liquidate to recoup any losses. In addition to collateral, there is a gauntlet of underwriting rigmarole that the owner has to go through before getting approved, or denied. Naturally, this reduces risk, which, in turn, brings the cost of borrowing down. So what about the short-term business loans? What's given up in exchange for getting a business loan faster and with less underwriting? The fact that there is less to go through when getting a short-term business loan makes it simple to understand that there is more risk involved. And don't forget about the collateral. These loans do not require any type of collateral, which also increases risk for the lender. So why would someone lend for a riskier scenario? Easy. They make up for the risk in cost. Fees are customarily higher if the risk is also higher. But these business loan companies typically do not measure fees by a rate. There is usually no interest rate in the sense that you and I understand. Something called a factor rate is measured as a decimal figure instead of a percentage and is typically used instead of an interest rate. These can be anywhere from 1.2 to 1.5. To find the total cost of the loan, just multiply the factor rate by the loan amount to find out the total payback of the entire loan. So someone borrowing $100,000 at a 1.3% factor rate will pay back $130,000. Let's put this into proper perspective for a moment. You may be saying, "Wait, Michael, that's too high." Let me ask you, have you ever owned a home? Let's say you have a mortgage with the low rates that offered in today's market. Did you know you will probably pay a 3.3 to 3.4 factor rate back over the course of 30 years? So if you borrowed just $100,000, you will pay back, wait for it, $350,000 back over the course of the loan. But there are many more scenarios that justify getting these short-term business loans. Go to the description below this video and click on the link to qualify within minutes, funded between $10,000 and $1 million within 2 to 4 days, and it won't cost you nothing.